In India, the government uses a system called Tax Collected at Source, or TCS, to ensure a steady flow of tax revenue throughout the year. Think of TCS as an advance tax payment on certain transactions. When you buy specific goods or services, the seller collects an extra percentage of the sale amount from you. This extra amount is the TCS, and the seller deposits it directly to the government on your behalf. Essentially, TCS acts as an interim tax payment towards your final tax liability. This system not only helps the government maintain a consistent revenue stream, but also helps track high-value transactions. By collecting tax at the source of the transaction, the government aims to prevent tax evasion and promote tax compliance among citizens. TCS applies to a wide range of transactions, which we'll delve into in the next section. TCS comes into play for specific high-value transactions outlined by the Income Tax Department. Some common situations where TCS is applicable include the purchase of motor vehicles exceeding a certain value, the sale of scrap materials beyond a specified limit, and payments received by sellers on e-commerce platforms. For instance, if you purchase a luxury car exceeding a predetermined price threshold, the car dealer is obligated to collect TCS from you at the time of sale. Similarly, if you sell scrap metal in bulk surpassing the defined limit, the buyer is required to deduct TCS before making the payment. The government regularly updates the list of applicable transactions and their respective TCS rates, so it's essential to stay informed about the latest regulations. The next section illustrates how TCS is calculated in a real-life scenario. Let's understand TCS calculation with a simple example. Suppose you are purchasing a luxury car worth 75 lakhs. The applicable TCS rate on vehicles above 10 lakhs is 1%. In this case, the TCS amount would be calculated as follows. TCS equals the value of the car minus the threshold limit, multiplied by the TCS rate. So, TCS equals 75 lakhs minus 10 lakhs, multiplied by 1%. This equals 65 lakhs multiplied by 0.01 comma, which gives us 65,000. Therefore, the car dealer would collect 65,000 as TCS from you, in addition to the car's price. This TCS amount is then deposited by the dealer to the government. Remember that this is just an example, and the actual TCS rates and threshold limits may vary depending on the nature of the transaction. It's crucial to note that the buyer, in this case you, can claim credit for the TCS amount paid while filing your income tax return. This ensures that you don't end up paying double tax on the same income. Section 4. Who collects TCS and at what rates? The responsibility of collecting TCS primarily lies with the seller of goods or the provider of services, depending on the nature of the transaction. For instance, in the case of a car purchase, the car dealer collects TCS. When selling scrap, the buyer is responsible for deducting and depositing TCS. TCS rates vary depending on the type of transaction. The government sets these rates. For example, the TCS rate for the sale of timber obtained under a forest lease is 2.5%, while the rate for the sale of liquor is 1%. It's important to remember that TCS is not an additional tax, it's an advance payment towards your overall tax liability. By understanding who collects TCS and the applicable rates, you can ensure a smooth and compliant transaction. Section 5. Meeting your TCS obligations, deposits and returns. Once the seller or collector receives the TCS amount, they must deposit it to the government's account. The due date for depositing TCS is generally the 7th of the month following the month in which TCS was collected. For example, TCS collected in April needs to be deposited by the 7th of May. Apart from depositing TCS, the collector is also required to file TCS returns. These returns provide details of TCS collected from various buyers or deductors during a specific period. The due date for filing TCS returns is usually the 15th of the month following the quarter in which TCS was collected. Filing TCS returns is crucial as it helps the government track TCS payments and reconcile them with the taxpayers' accounts. Failure to deposit TCS or file returns on time can attract penalties and interest. Section 6. TCS versus TDS, Unraveling the Distinction. While both TCS and TDS involve collecting tax at the source, they have distinct characteristics and apply to different situations. Let's break down the key differences between TCS and TDS. 1. Nature of collection. TCS is collected on the sale of specified goods, while TDS is deducted from payments such as salaries, rent, interest, and professional fees. 2. Responsibility. The seller collects TCS, while the payer deducts TDS. 3. Point of deduction. TCS is collected at the time of sale, while TDS is deducted at the time of making payment. In essence, TCS primarily focuses on tracking high-value goods transactions, while TDS aims to collect tax from various income sources. Understanding the distinction between TCS and TDS is vital for accurate tax compliance. Section 7. The importance of TCS compliance. Complying with TCS regulations is crucial for both buyers and sellers. For sellers, collecting and depositing TCS on time ensures they avoid penalties and interest. It also helps maintain a positive track record with tax authorities. For buyers, TCS compliance allows them to claim credit for the tax already paid on their purchases. This credit reduces their overall tax liability when filing income tax returns. Moreover, adhering to TCS rules fosters transparency and accountability in financial transactions. By understanding TCS regulations and fulfilling their obligations, buyers and sellers contribute to a fair and efficient tax system. Staying informed about TCS updates and seeking professional guidance when needed can go a long way in ensuring seamless tax compliance.